Hello, 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 friends and family. Tony Warfield here. I don't know if you can tell by the enthusiasm in my voice, but I'm pretty motivated about having this discussion. Discussions like this help me to help our community build generational wealth. This type of information definitely helps us move forward as a community. So I'm pretty excited about being able to learn more about this information and being able to share it. And hopefully after you listen to the video and take a look at some of the examples that you'll be pretty psyched out about it as well. So let's get started. The discussion is how a loan works in indexed universal life insurance policies. This video provides a simplified answer to a very detailed question. Each situation is unique. A one-on-one discussion would be more beneficial. So you can imagine some people are in different places in their lives. So because of that, we want to make sure that we sit down and look at your particular situation because, some things might be more advantageous. Some options might be more advantageous to you with the IUL, and the IUL offers a lot of really great options for you to be able to take advantage of. So looking at your personal situation one-on-one will definitely benefit you. There's basically two types of loans that are available. So you have your fixed loan option. These loans are pretty standard in whole life and in index life. Basically, you will be charged between 2 and 6% to borrow your money, yet you will be credited an equal amount. So you basically pay nothing to borrow your own money. Participating loans, they're most common. The insurance company is going to charge you somewhere between 3 to 8% for the use of their money. Each contract is different, but you will have all the money accumulated in your policy participating in the index. You do not know what your credit is going to be. It could be as high as the index cap versus the index dropping, and you do not make any interest at all. It depends on how your policy performs. You have three accounts involved that you should know about: your bank, your policy, the life insurance company. How IUL works is, say you have your bank account, no money's in it. You have your policy, say the cash value is $100,000, and of course the insurance company, they have all the money. Your question could be, I want to borrow $50,000 from my IUL. Where does the money come from? The answer to that is it does not come from your life insurance policy. I know that's the misconception that a lot of people have, but the money actually comes from the insurance company. So in a participating loan, the funding source would be the insurance company. So here in this pictorial, you see that your bank account is credited $50,000 from the insurance company, yet your insurance policy's cash value remains the same at $100,000. So why would the insurance company just give me $50,000? Well, this is America. No insurance company is just going to give you $50,000 unless they have a real good reason. But in this case, the insurance company places a lien on your policy's cash value / death benefit, using it as collateral. No money is leaving your policy. Yet if you die or cancel your policy, the lien amount will have to be paid back. Yet you get the balance, or your beneficiary gets the balance of the loan as it is settled. So looking at this pictorial, you see that the money, the $50,000 lien, is placed from the insurance company to your policy. Yet the money comes from the insurance company to your bank account. You borrow $50,000 from the insurance company using your policy as collateral. Your accumulated cash value remains the same. So question, let's say you borrow $50,000 at a 5% interest rate. The S&P is up 10%. What happens in your policy account? The answer to that is you still have $100,000 in your policy. It earns 10% for that year. You will earn $10,000. Your account total will be $110,000. So some of the advantages that we want to discuss is, in this example, you borrow $50,000 at 5%. The charge would be $2,500. You kept your accumulated cash in your policy account. Your account grew 10%, adding an additional $10,000 to your policy account. Your net profit will be $7,500 minus the $2,500 that you were charged at 5%. Your policy account would be worth $110,000 less than $2,500. If you transition prior to the loan being paid back, the loan is paid using the cash value / death benefit. Your beneficiary gets the balance. If you had taken the money from your policy using a fixed loan, the same growth for that year, you would have earned only $5,000 on the remaining $50,000 cash value. Your net profit would be $2,500 instead of $7,500 for the year. However, each subsequent year, your overall growth in that account will continue to diminish. So that said, you will be losing money on that account each year until the loan is paid back. Another advantage is the loan provisions and access to your money at a lower rate is far better than with a fixed account. So the IUL disadvantages. In this example, if the S&P drops to minus 10%, your policy account gets no performance credit. This is due to the IUL having a capped maximum depending on the IUL you have, and it also has a capped minimum. The company I am partnered with has a 0.25% minimum. So even with that, if your S&P drops to minus 10%, you don't lose any money in your account, but you don't have any credits going to your account as long as your S&P has dropped that low. Your lien balance will grow 5%. This means your lien balance will grow 5% and offset by your policy death benefit or cash benefit. However, this is a long-term option in which the performance of your policy on average yields interest rates higher than the interest charged on your loan. If your policy company, if your insurance company has loan rates higher than the average, you will be locking in negative earnings spread between your policy performance versus the interest rate charged on your loan. Now, traditionally, most banks, most insurance companies are only going to charge you between 5 and 6%, but there are some out there that charge you more than that. You definitely want to sit down and take a look at what they are going to be charging you for if you were to take a loan against your IUL. So if the interest rates that they're charging you are greater than the average yield or the average performance of your IUL, I would reconsider getting a loan. I would not. So you definitely don't want to be losing money, even if you are taking a loan against your account. The whole idea behind using an IUL is to be able to take advantage of the benefits of the IUL. Anytime you're taking less or earning less money in an IUL, whether it be with a loan or whether it be against the S&P, then you might want to consider how that performance will affect you. So question, why should I be charged to borrow money from my own life insurance policy? So even though we just basically discussed that is a valid question because a lot of people will ask that. So with that, let me answer that question in two parts. Part one, if you borrow the money directly from the policy, as with the fixed loan, you essentially do not pay anything as you are credited the same interest you are charged, basically a wash. Yet when you take money out, you lose the performance power of the entire balance. This in effect could cost you more money than interest charged for the loan due to decreased performance. So after the first year, if you still owe the balance of your loan, the accumulated value remaining in your account does not earn as much money having been cut in half or less whatever your loan balance was. It does not earn as much money regardless of whatever the percentage rate that has gone onto your account. So part two is, in a participating loan, you could earn up to the cap or as high as 15% or more. Having your full policy's cash value could generate a profit even with a sizable loan using the policy as collateral. This means you could generate a profit even when taking a loan. So a good example of that would be, let's look at this comparison. So you have your fixed and your participating loan. In both situations, you have $100,000 cash value borrowing $50,000. Yet with the fixed loan, your policy balance will be down to $50,000, where you still have $100,000 left with a participating loan. The rate will be 5% for both, The credit for the fixed will be 5%. So it's basically a wash. Your overall charge will be nothing. Your rate will be 5% with a credit depending on the performance of the index. So it could be more or less, but the overall charge for the loan will be $2,500. So you can imagine if the performance for both were 10% and the interest that you earned for your fix was $5,000, that will give you $55,000 balance. Your balance would be $55,000, whereas your balance for your participating loan will be up to $110,000 because you earned 10% of $100,000, which will give you an additional $10,000. So you can see the differences there. Now, please understand that the loan has to be paid back. So with that being said, if you don't pay the loan back yourself, then the loan will be paid back and your beneficiaries will get the balance from your cash value / your death benefit. So in summary, using the IUL loan option will give you tax-free supplemental retirement income. This is huge. And understanding where the money comes from will ease your mind, knowing your cash value continues to earn interest while you repay your loan. You can repay your loan as quickly or as slowly as you wish. If you do not repay your loan, the loan will be repaid using the cash value / death benefit after you transition. Transition meaning you die, quite simply. Your beneficiaries will receive the balance. The loan rate on average will be less than the average earning performance of the IUL. So some people, they might have a whole life policy, and on average, as I understand it, because I don't have a whole life policy, but on average, they're looking at about 4 to 5% yield for a whole life policy. Well, if your loan rate is 5%, you technically don't really make any profit with that particular setup. So IUL is something that's definitely a good option for people that it works for. It's not for everyone. It was definitely for me. So being able to sit down and have a discussion on how that would benefit you would be great. And I think it will definitely benefit you and your family moving forward. If you have enough money being accumulated in your cash account, the returns could be great as you continue to save the money in your IUL account. So any questions or comments, please feel free to contact me directly with the number down below or email. I definitely appreciate comments and statements. If you have any topics that you're most interested in, please feel free to contact me directly or leave a comment. Depending on where this video is being viewed, whether it be YouTube or somewhere on social media, leave your comments. I'm very good about getting back to you and to all the people that are taking a look at those videos that I put out there. And every week I'm going to be adding more videos. So make sure you stay tuned. And once again, thank you so much for sharing this time with me. I'm looking forward to us as a community growing and being able to take advantage of that generational wealth. And with that, I bid you a great day.